Chapter 5, Deductions for and from Adjusted Gross Income, AGI. The first learning objective explains how health savings accounts, HSAs, can be used for tax-advantaged medical care. Health savings accounts, HSAs, are a type of savings account which may be established for the purpose of paying unreimbursed medical expenses. To qualify, taxpayers have to carry a high deductible medical insurance. Deductions for AGI allowed for: the earnings and unused balance accumulate tax-free. This is only allowed if the taxpayer has a high deductible insurance. High deductible insurance is defined below as deductibles greater than $2,700 for a family or $1,350 for an individual. Contributions can be limited based upon if the HSA is covering the family or the individual only. The contribution limit for 2018 for a family is $6,900. For an individual, it is $3,450. You can also make an additional contribution if you are over the age of 55. You may make $1,000 additional per qualifying spouse or $1,000 for your individual, if it's an individual plan. If you are age 65, you can no longer contribute to an HSA because you qualify for Medicare. HSA contributions must be made by April 15th of the following year. Contributions to an HSA are shown on Form 8889. So if I want to make a contribution and it counts for my 2019 HSA, I would make it by April the 15th of 2020. And remember, all of these numbers that we're looking at are 2018 limits. They are adjusted each year. Distributions from an HSA are tax-free when used to pay for qualified medical expenses. Distributions which are not used to pay for qualified medical expenses are subject to both a 20% penalty and the income tax that would have been charged on the distribution. However, if you're over the age of 65, distributions taken for non-medical expenses are subject to tax but not to penalties. Remember, at the age of 65, you no longer qualify for an HSA because you qualify for Medicare. Distributions from an HSA are reported on Form 1099-SA.